Good evening, students. Welcome to the session. So, what we are going to do today we are going to start with the assessment of the AOP and BOI. We have done till taxation of the partnership firm. Can anybody recap for the taxation of partnership firm what we have done in the last class?
Uh, it will be taxed at 30%, surcharge of 12% if total income is greater than 1 crore, plus 4% cess. Conditions, remuneration to the partners. It is paid only to the working partner and it should be authorized by the partnership deed, and it should not pertain to the period prior to the partnership deed, and amount should be specified in the partnership deed, whether it is a ratio or fixed amount. Then, moreover, it should not exceed the specified limits. The limits are book profit for first 6 lakhs or loss. The amount is higher of the 3 lakhs and 90% of the book profit. For above 6 lakhs, it is 60% of the book profit. Here the book profits are net profit as per PGBP less unabsorbed depreciation, because as this is consideration as a depreciation of the current year, we will exclude brought forward losses and any remuneration paid to the partners. And in the hands of the partner, it is taxable under 28(5) PGBP income. If some remuneration is disallowed in the hands of the firm, then it will not be taxable in the hands of the partners.
Right.
Then interest on the capital, same, but it should be 12% and remaining everything is same. TDS under section 194T, 10% if it is greater than 20,000.
Yes. And what about the representative capacity?
If the partner is showing in the representative capacity, then it is subjected to the section 40B. And if the partner is giving in individual capacity and he is not a partner of the firm, then it will 40B will not be applicable to that person.
Right. Now, next we are going to move towards the taxation of the AOP and BOI. What is the difference between the AOP and BOI?
In body of individuals, they cannot be a company.
Yeah,
In
that's right.
AOP, they can be a company.
That's right. So, what are the tax rates for the AOP BOI?
Slab rates that are applicable to individuals.
That's right. So, AOP basically considers all the person, BOI only has individual, right? Now, tax rate here is what is applicable to the individuals, right? So, slab rates as applicable to the individual. So, do we have both the regimes over here?
Yes.
Right? So, normal tax regime as well as section 115 BAC. What is the surcharge?
Surcharge that will be 37 for old and 25 for default regime.
No. So, surcharge is as applicable to the individual. However, there are exceptions. What is the exception? The maximum surcharge shall be 15%, both under the normal as well as 115 BAC regime. Under what circumstances this will be there? Yes.
If total
If
income,
income is taxed under capital gain or only the risk company as members in the AOP or BOI.
Right. So A, the tax payable is there on the special rate or at the special rate. So income is taxed as either the capital gain under 111A, 112 or 112A. Right? Long term, short term capital gain which is there. Or the tax is payable under section 115 AD, which is for the foreign portfolio investors, right? And right, these can be the situation, and where the AOP consists of only company as its member. So in these two circumstances, the surcharge will be applicable at the rate of 15%. Right? Okay? Yes or no? Is this clear?
Yes, ma'am. But
Right?
in any other
Yes.
cases, if these two conditions are met, the old surcharge that is applicable to individual,
Yes.
like 37% for
Yes.
old regime and 25% for default.
Correct. Yes. So if these two conditions are not satisfied, then in that particular case, the normal surcharges will be applicable. Under the old scheme, 37%. Under the new scheme, the maximum one is 27%, 25%. So that shall remain the same. Okay? Yes or no? Any questions?
clear, ma'am.
Okay. So let us proceed further with respect to the now computation. So, okay, before moving to the computation, there is exception to the constitution of AOP or BOI. What is that exception? This one point you should remember. What do we understand before moving towards the exception? What do we understand by AOP or BOI? In which circumstances we can say that this is AOP or BOI? Yes.
Group of people come together to do something.
Yeah. So group of people coming together for common purpose, for earning profit together, to produce income together, right? That will be constituting the AOP or BOI, right? So where their actions are concentrated towards earning either the income or achieving some purpose, that is like basically AOP. Now the exception to that is that the co-owners,
Ma'am, uh,
yes,
even group of people coming together, there, then that is also a kind of partnership also, right, ma'am?
see partnership which is there, that is different from AOP. In partnership, you have the predetermined arrangement that you are entering into as a partners, right? So that is governed under the Partnership Act 1932, right? There where the people come together as the partners, and they are not, just like coming for a small purpose or for particularly earning the income for a certain period of time. They are doing there for a long-term basis. And sorry, if we look at the Indian Partnership Act 1932, that basically talks about, the Indian Partnership Act talks about that the partnership which is there, that is the kind of arrangement between the partners which is governed under that particular Indian Partnership Act only. So, who are agreeing to do the business together, to share the profits, to share the losses, and they are having this kind of arrangement of having the partnership basically. Whereas under the AOP, the case is not like that. There just the people come together, they are not forming technically a partnership, a formal thing. See, under the partnership, it's not necessary that you have to register your agreement. You can have unregistered agreement, but there is an oral agreement in place. Under AOP, there is nothing like that. AOP may the people will come together, let's say, to build a highway, to complete one particular project. So they are not having any formal, arrangement per se, something like that. So that is the reason why we have this AOP and BOI in place. So if we have some formal arrangement in between, then it is a case of partnership. If no, then in that particular case, it's the AOP. So partnership is more like a formal business arrangement with a governing act. The AOP is just, kind of 2-3 people coming together to do the business or to attain a particular objective. And could be for temporary period, not for a long-term period. Clear?
Yes, ma'am. Clear, ma'am.
Also, one more difference between the partnership and AOP is that in the partnership, the partners are operating on the principle of mutual agency. What do we mean by mutual agency? Decision of one partner will bind the all other partners and the firm. That's not the case in AOP. They are working on independently. Right? So, that is something also a big difference between the partnership and the AOP. Okay?
Okay, ma'am.
Yes. Now, the exception to this is that the co-owners of the house property will not constitute the AOP. So, this is an exception. Co-owners of the house property cannot be assessed as AOP. Even though they are co-owners, they do not constitute the AOP. Where is this exception coming from? Any idea? 26. Okay. Now coming towards the computation of income. How do we compute the income of the AOP? So you have two categories. One is where the shares of the members are known. And second is are unknown. Fine. Where the shares of the members are known and where the shares of the members are unknown. Now, when the shares of the members are known, meaning that we know what is the arrangement between them to share the profit and losses. Sorry. So in case if the individual share of the members are known, okay, like there is a predetermined sharing ratio of the profit and losses. In that instance also we have again further categories. The total income of any member excluding his share, excluding the share of AOP or BOI, is greater than basic exemption limit. So if the total income of any member is greater than basic exemption limit. Now what are the basic exemption limit? What is the
It's
basic exemption limit?
3
4
lakh.
lakhs in 115 BAC and 2.5 lakhs in old.
Right. Not 3 lakh, 4 lakh or 2.5 lakh. Then 3 lakh for the senior citizen, right? And very senior citizen is 5 lakh. Right? These are the basic exemption limit. Yes or no? So if the total income of any member is greater than the basic exemption limit, again there we have the further subcategories. If any member is taxed, has a tax rate of greater than MMR. Right? For example, foreign company. Okay? Then in that particular case, how will the tax work is or the computation work is? The portion of income attributable to that member whose income is taxed at greater than MMR, the AOP will be taxed at rate greater than MMR. Right? So whatever portion of income of that member will be, to that extent, the AOP will be taxed at the rate greater than MMR, whichever rate is applicable to that member. The balance income. The balance income, AOP, to pay tax at the rate of MMR. So if any member has a tax rate greater than MMR, then the portion of that member's income that will be taxed in the hands of AOP at the rate applicable to that member. Balance income will be taxed at MMR. And if no member has a tax rate greater than MMR, then AOP will be taxed at MMR. Okay? Now, what is the maximum marginal rate under the old scheme? Yes,
42, 42.74.
42.744%. Right?
Yes.
Yes?
Yes.
So, MMR is what about new regime?
It's approximately 39%.
39%. Yes, are we clear up till this? This portion is clear to everyone?
Yes, ma'am.
Okay. Now, the next part is the AOP's member shares are unknown. We are not aware about how they are going to share the income. So, where the members' shares are unknown. So, in case the shares of the members are unknown, in that particular case, again we need to check that whether any member has tax rate greater than MMR. right? So in that case, AOP to be taxed at higher rate. And no member has tax rate greater than MMR. If in that case, if no member has tax rate greater than MMR, then AOP to be taxed at MMR. Fine. Is this clear table?
Yes, ma'am.
Okay. Now this what we have discussed about the AOP's taxability. Now what about the taxability in the hands of member? So in this first situation, I think here this information has gone off. No member has income excluding the share. Greater than basic exemption limit. In that case, AOP to pay tax at slabs, where no member has income greater than basic exemption limit, AOP to pay tax at the slab rate. Now slab rate will be as per either 115 BAC or old regime. Right? Now in the hands of members, in the first situation, where the shares of the members are known and the members have the income greater than basic exemption limit. And if any member either has tax rate greater than MMR or has tax rate less than MMR. But the principle is that they have the total income greater than basic exemption limit. In that particular case, the share of the member will get exempt because the AOP is already paying the tax at the MMR. The share of the income for the member, the share of AOP income will be exempt under section 86. Now, can you recollect something around this point under MAT?
Share of members in AOP or BOI where no tax is payable under section 86. For that, any expenses we will be add back, and for any income we will be reduced.
Correct. So, if we go back to our MAT classes, right? Here, we had written that add or less the share of the member in the AOP or BOI when no tax is payable under 86. We used to add expense and less income. We also did a sum on this point, right? So where the AOP is paying the tax at the MMR and the share of the profit is exempt in the hands of the member, and if the member is a company, right? If the member is a company, no MAT on the share of profit from AOP. Exclude from book profits. Clear? Yes?
Yes, ma'am. Clear, ma'am.
In the second case, where no member has income greater than basic exemption limit and the AOP is paying the tax as per the slab, then in that case, in the hands of member's share will be included in the income under section 67A, and a rebate will be allowed to the members under section 110. Okay? So where the AOP is paying tax as per the slab rate, the members' share will be included in their income under section 67A and the members will get rebate under 110. We'll see this. And in the last situation where the members' share are unknown and the AOP is again paying the tax at rate greater than MMR or MMR, then again in that case, members' share exempt under section 86 if member is company, no band. Are we clear up till this point?
Yes, ma'am.
Right? Any questions, any doubt? Okay. Now we'll see how this particular thing is worked out. Where the AOP is paying the tax as per the slab rate. So, computation of share of member, let's write like that. Share of member under section 67. Okay. So the step one will be compute the share of income from AOP or BOI. And this has to be the share of the profit only. So this will exclude any interest, remuneration or commission paid to members. Right? Now apportion the share under the different heads of income in the same manner as characterized in the AOP's hands. So let's say for example, if the AOP is having the income under the head house property, PGBP and capital gain, the share of the member also you will apportion under the same heads of income, the way it is characterized in the AOP's head. Step 2 will be add interest, remuneration or commission. Right? Step 3 will be less any interest on loan taken by the member for investing in AOP or BOI. Right? This will give you the total income from the AOP or BOI. What you will do is you will find the tax on the total income. You will find the tax on the total income. Then arrive at the average rate of tax. What is the average rate of tax? It will be total tax divided by total income. Then you will do the calculation of the rebate. How is rebate under 110 calculated? Rebate will be total income from AOP or BOI into average rate of tax. Are we clear? Yes.
Yes, ma'am. प्रॉब्लम करेंगे तो क्लैरिटी आएगा.
Yes, we are going to solve a problem on this. But before that, I want to talk about the remuneration from the AOP or BOI. So in the partnership, as you mentioned that the remuneration or interest paid to the partners is allowed as a deduction subject to the conditions, right? That it should be in accordance with the partnership deed. It should be pertaining to a period after the partnership deed, right? And the limits which are mentioned. But any remuneration or interest paid to the members of the AOP is not allowed as deduction to AOP. So, any interest or remuneration to the members of AOP is disallowed. However, if the interest or remuneration is paid to the member in individual capacity, then for example, in the case of like where the interest is paid to the member who has given the loan, right? Who has given the loan to the firm. Now, that particular member is acting as a representative for, let's say, an HUF who is a member. Like the same way we had seen in the partnership. If ABC HUF is there, but the loan is given by Mr. X in his personal capacity. Whether it will be subject to disallowance under 40BA?
No, ma'am.
No, right? So here, this will be allowed. Right? Then if individual is a member, however, if interest is paid to him for the benefit of third person, for example, for the loan given by his wife, Whether it will be disallowed?
No, ma'am. Individual separate
Correct.
allowed.
So this is not given by individual himself, who is a member, but by his wife. Okay. Is this clear? Any questions, any doubt? Let us solve a question from the module. Let us look at it. JK Associates is an AOP consisting of two members, J age 40, K age 37. Share of the members are known, 60% and 40%. Income of the AOP for previous year 25-26 is 11 lakh. J and K's income other than the income from AOP amounts to 2.5 and 2.9 lakh respectively. Compute the tax liability of the AOP assuming that J exercises the option to shift out of the default tax regime and AOP and its member K pays the tax under the 115 BAC 1A. So let us first talk about J. What will happen in J's case?
J has an income less than the basic exemption limit.
Yes.
So,
How would the
So
AOP taxed?
one of the member is having a income greater than basic exemption limit.
How it is greater than basic exemption? K is
Okay.
paying the tax under
no,
default tax regime 115 BAC 1A.
Okay.
no member has
Correct.
income.
No member has.
Correct. So the
Yes.
share of the members are known, right? And no member has the income greater than basic exemption limit apart from the share of the AOP or BOI. Correct? So in that case, how the AOP is taxed?
Slab rate.
Rates.
Right? Now AOP has been paying the tax as per the default tax regime. Right? So what would be the tax liability of the AOP? Calculate. The income of the AOP is 11 lakhs.
62,400.
62,400. Yes. Everybody getting this answer? What is it? It is 52,000.
$52,000.
52. So up 4 to 8 lakh, 5%, 8 lakh to 11 lakh, 10%. And the 4% cess. Yes, 52,000. Yes or no?
Yes, ma'am.
Okay. Now, what would be the J's income? How will you compute the income for J? His income apart from the AOP income is 2.5 lakh. Right? So first step is identify what is the AOP income. AOP income is, the share is 11 lakh into 60%. Yes? 11 lakh into 60%, 6 lakh 60,000. For K, it is 40%, so 4,40,000. Now, here we are taking it as share of profit from AOP only, but because here we do not have the information about under what head this 11 lakh is taxed. If there is an information given that the 11 lakh is taxed, let's say 2 lakh under PGBP, 10 lakh under, 8 lakh under capital gain, right? And 1 lakh under IFOS. So the ratio is 2:8:1. So then what we will do is for 6,60,000 also we will distribute in the same ratio. 6,60,000 into 2 divided by 11 will be taxed under PGBP. 6,60,000 into 8 divided by 11 will be taxed under the capital gain. And 6,60,000 into 1 divided by 11 will be under E-force. But here we do not have that information, so we are taking it as is. The income from other sources 2.5 and 2.9. I'm sorry. So, what will be the tax liability? He has gone for the old regime. He has gone for the 115 BSC. So, this is what tax liability comes to, right? Now, on this 98,280, we will divide it by the total income to get the average rate of tax. This is 10.8. Similarly, this is 2.351. Now, the rebate under 110 will be 10.8 into 6,60,000 and 2.351 into 4,40,000. You will reduce that and you will get the tax liability of the members. Clear?
Yes, ma'am.
Yes or no?
Yes, ma'am.
Fine. Any questions? Any doubt? Yes?
Clear, ma'am.
Clear? Everybody? Okay. So let us move to the next topic now. Taxability of the income of HUF.
Ma'am,
Yes.
अभी interest or remuneration is to the members is disallowed, right, ma'am, for AOP
Yes.
and BOI. So, since it is taxed in AOP or BOI, then it will not be taxed in the hands of the members,
Yes.
like in partnership. क्योंकि यहाँ पे एक टैक्स हो गया तो वहाँ पे टैक्स नहीं लगेगा.
See, here, partnership may there is a specific exemption in terms of that proviso, which is saying that the AOP or BOI's, the partnership remuneration, which is not allowed as a deduction, will be not taxed in the hands of the partner. Here, we do not have anything of that sort. So, the similar kind of exemption does not exist for AOP or BOI. So, the partnership may there's a specific mention that if the remuneration is disallowed, it will not be allowed in the hands of the, it will not be taxed in the hands of the partner. But here, nothing of that sort is mentioned. So therefore, it will be not allowed to the OP or BOI and it will be taxed in the hands of the member. Clear?
Okay, ma'am. तो मतलब same income पे दो जगह टैक्स
Correct.
लगेगी.
Correct.
Okay. Okay, ma'am.
Yes? Okay. Now moving towards the HUF. How are the HUFs taxed?
Same individuals slab rates.
Correct? HUFs are taxed as per like the same way the individuals are taxed, right? Into undivided family. So the tax rate will be same as individual. What is the surcharge? Yes.
Same as 25-37%, same as
Same.
individuals.
Same as individual. So if the income is dividend, capital gain, taxed at special rate, then in that particular case, the maximum surcharge is how much?
15%.
15%. So tax rates are same as the individual. Now in respect of computation of the income, any income from the property transferred to HUF for inadequate consideration. What will happen in this case?
Clubbing of provisions will happen.
Very good. So if you recollect, we had done the clubbing of income. There we had seen that any asset transferred to the trust, HUF, AOP, any person, and this income is to be used for the benefit of spouse of the settler, or this income is basically for that person itself. Sorry. So in that particular case, the income will be clubbed in the hands of the settler. Yes or no?
Yes,
So
ma'am.
here, in this case, what I'm saying is that where the consideration for inadequate consideration, the asset has been transferred to the HUF by the settler. In that case, we will have the clubbing provisions getting attracted. So this income will be clubbed in the hands of the settler. So this will be income of member, not of HUF. Fine? Yes. Is this clear?
Clear, ma'am.
Okay. So any income arising to the HUF from the property transferred to the HUF for the inadequate consideration. So 64(2) gets attracted. Either for him or for the benefit of the spouse. Yes. Fine, you recollect this. Okay. Next is the income which is, or the share of the profit from the HUF. What will be the taxability of that for the members?
It is exempted.
Is exempt. So, share of HUF exempt under 10 to 8. Sorry, 10 to, not 10 to 8, 10 to. Okay. Next is remuneration to the member of the HUF. Remuneration to the member of HUF. Yes. This is
allowed as deduction.
Allowed as deduction to the HUF and taxable in the hands of member. Fine. Then receipt of gift by the HUF.
मैम यहाँ पे कोई limitations नहीं है क्या मैम?
नहीं. No limitations. Receipt of gift by the HUF. 56 to 10. Right? However, if the gift is from member who is relative, then 56 to 10 is not applicable. Yes. However, in the hands of member, what will apply? (64)2. Clubbing. Yes or no? Yes?
Yes, ma'am.
So when the gift is given to the member, so gift is given by the member, so that means it is for the inadequate consideration. Now in the hands of the HUF, if it is from the relative, not a problem. But for the member where the individual who is a member of the HUF has converted the property into the HUF, right? Then in that particular case, the income of the individual member will include the income from that property. Clear? Yes or no?
Yes, ma'am.
Yes.
Okay. Any distribution of capital asset on the partition of the HUF. Total or partial partition. What is its tax implication?
Exempt in the hands of members.
In the hands of the HUF also, not a transfer under section 47. So no capital gain because this is not regarded as transfer under section 47. And in the hands of member, whether there will be 56 to 10 applicable?
No.
No. Okay. So there is nothing new in terms of the applicability of the HUF. What is important here is just we have consolidated all the provisions applicable to the HUF. Clear? So in terms of the assessment of the HUF, there's nothing new. HUF is taxed as a separate person from its member. It's a distinct entity. Right? Any questions, any doubt?
No, ma'am.
Okay. So this completes your HUF also. The next is taxation of the cooperative society. Now again here it will be just a consolidation of what we have done, nothing new per se. Okay. So first of all, what is the tax rate for the cooperative society?
Normal old regime up to 10,000 10%, 10,000 to 20,000 20%, greater than 20,000, 30%.
Yes.
Surcharge 7%, 12%. Set 4%.
Yes. Yes. So I think we had done for the cooperative society. Yes. Normal tax regime up to 10,000, 10%, 10 to 20, 20%, and greater than 20, 30%. And the surcharges 1 to 10 crore, 7, and more than 10 crore, 12. Then you have two optional tax regime, which is 115 BAD and 115 BAE. 115 BAD is 22% plus 10% plus 4%. Sorry, without claiming the deduction under 10AA, additional depreciation, scientific research for outside expenses, 33AB, 33ABAT, coffee rubber development, any chapter 6A deduction, brought forward business losses, right? Unabsorbed depreciation relating to an additional depreciation. So in that case, this is the tax rate. Or for the manufacturing cooperative society, it is 15% plus 10% plus 4%. But the conditions are that the entity should be engaged in the manufacturing, or the cooperative society should be engaged in the manufacturing of the goods or generation of the electricity. Same just like your 115 BAB and 115 BAA. Same thing. Yes, there's nothing different over here. So here you will get the normal depreciation. You will get the expenses for in-house computer, in-house software research expense, in-house research expense, scientific research expenses. Then ATJJAA, ATLA, ATP is not allowed, right? And the other income, if at all it is there, in case of 115 BAE, it will be taxed at 22% at the gross basis. STCG on non-depreciable asset without, 22% with the deduction of the cost of asset or the expenses. For any other income which is not incidental to manufacturing, it is taxed on gross basis. The condition is set up and register after 1423 and commence manufacturing before 1424, not used old plant and machinery, but the exception is less than 20% of the total value of plant and machinery or imported plant and machinery. And here, the transfer pricing is applicable if the transaction is greater than 20 lakh with the AE, then the arm's length price is applicable. And that will be taxed at any unreasonable profits will be taxed at 30% plus surcharge of 10%. And any other income chargeable at special rate will be taxed at special rates. Clear? Yes or no?
Yes, ma'am.
So, normal 115 BAD or 115 BAE. Refer basic concepts. Okay. Then you have something called as ATP deduction. Yes or no? This also we have done in the chapter 6A class. Yes. Then for the cooperative society, there is concept of mutuality. What is the concept of mutuality?
One
Yes.
cannot earn profit from own self.
Correct. One cannot make the profit from one's own self. Fine. So we had seen that the cooperative society are governed by the principle of mutuality. So in that particular case, we had seen a lot of example also that where the mutuality is not applicable. In case of Secunderabad Club, interest received on FD from the member banks not governed by the principle of mutuality because there was no identity between the contributor and participator, right? And there was a taint of commerciality. So we had seen a lot of examples over there. For example, in the case of the non-occupancy charges, membership charges, transfer fees, common amenity fund charges. In case of Venkatesh Premises Cooperative Society Limited case, we had seen that the concept of mutuality is applicable. Right? Yes or no? So you can just write it over here. membership fees, non-occupancy charges, then transfer fees, common amenity fund charges, not taxable, on account of mutuality. Right? Here you can refer the case of Sri Venkatesh Premises Cooperative Society. Supreme Court. Yes? Interest on FDs kept with member banks, we saw that it is taxable, mutuality is not applicable. Fine? Any questions, any doubt? Okay. So this is about the cooperative societies person. So we have completed all the persons which are there under your module also. So we have first started with the company, right, wherein we had gone through the tax rates of the company. Then we had seen the MAT provisions per se. Then we talked about the individuals. We saw the AMP, which is there. Then we spoke about the partnership firms, then AOP, BOI, then the HUF, and now the cooperative society. Any questions you have? Yes. Any doubt, any question? Yes, students.
Common.
Okay. Now, here, what are we then left with? Nothing per se, because we have completed the entire chapter here. Now, some cases that I would want to discuss, which are there as a part of your module, that we will cover. And then what we will do is we will, and we also, saw a lot of questions in respect of like, the generally math ho gaya, then the partnership also we had solved some questions. So I'm not solving any more questions. You will be required to practice on your own from the module. We will be directly starting up with the next chapter. Okay. So first we'll discuss the case, we'll take a break, and then we'll start with the next topic. So let me just share the module with respect to the case laws which are there. Yeah. This is the Madras High Court ruling in case of metal and chromium platter. The question here before the court was, should capital gain exempt under 54 EC, which forms part of the net profit in the statement of P&L of the assessee company, be taken into account for the calculation of book profit? So when you sell something and you are like land and building, you can claim under the normal tax provision the exemption under 54 EC if you deposit it within the 6 months into the specified bonds, right? Now the question before the court was that if those capital gain are included in my book profit, will MAT be applicable? Because ideally under normal provisions, we are exempting it under 54 EC. So the Madras High Court here noted that under the normal tax provision, 54 EC is applicable. And since under the normal provision 54 EC is applicable and the capital gains are exempt, these capital gains forming part of the net profit should also not be taken into account for the purposes of the MAT. Otherwise, the intention of exempting this capital gain will be defeated. Are we clear? Did you understand this? Yes?
Ma'am, can you explain once more?
Yeah. So the question here was that in this particular case, the 54 EC exempts the capital gain. Now, whether I will include, when this capital gain is included in my book profit, should I be paying the MAT on it? So, the Madras High Court has interpreted here Section 115JB5 to say that if the capital gains are exempt under 54 EC, then under 115JB, we should not be including these capital gains for the purpose of MAT calculation in the book profit. Clear?
Clear.
Yes. So even though there is no separate explicit adjustment given under 115JB, still Madras High Court has gone ahead and given this particular exemption basis the intent of 115JB. So if you look at the 115JB, it is providing for the explicit adjustments. And section 5 of 115JB, subsection 5 of 115JB clearly says that except as provided in this section, all the provisions of the Act as applicable to the total income shall apply to the book profits. Remember, I told you the book profit shall be deemed to be the total income. So all the advance tax provision, recovery, assessment, 234B, 234C equally applies to the book profit. Right? So the CBDT circular had clarified that except for the tax payable on the book profit, which has to be calculated under 115JB, all the other provisions of the assessment, recovery, advance tax, interest will be equivalently applicable to the book profit as they are to the normal income. So this particular provision has been interpreted very widely by the Madras High Court to say that if all the provisions of the Act, except for the calculation of the MAT on the book profit, applies as it applies to the total income, so the 54 EC should also apply to the book profits. Clear? Yes?
Yes, ma'am. Clear. Yes, ma'am.
Okay. Next is Trans-Asian Shipping Corporation. The question was, can the income derived by an Indian company from slot charter arrangement in other ships be computed applying the tonnage tax scheme in spite of non-fulfillment of the condition of holding a valid certificate in respect of such ship? So here the Supreme Court had noted that just because the assessee company could not produce a certificate, right? Here the company could not produce the certificate, valid certificate in respect of the ships, which is a prerequisite condition for claiming the tonnage tax scheme. Right? And the tonnage tax scheme, what did I tell you? It will include what kind of ships? Ships or the inland vessel. Which has to be, the tonnage of that ship or vessel has to be indicated in the certificate. So, the tonnage which is there, whether it will include the arrangement of purchase of the slots or the charter arrangement in the other ship. Now, what is this charter arrangement? Any idea? Yes? Any idea? It is basically a contract between the shipping companies for hiring another ship to transport the goods or passengers. So instead of taking my own ship, I am putting my passengers or goods in the other ship. So the Supreme Court here noted that the requirement of producing a certificate would not apply when the entire ship is not chartered. And where I have just purchased these slots, like I have not booked the entire ship, I have just purchased the slots in that ship. So income from a slot charter arrangement can be computed using the tonnage tax scheme. So what is here the ruling trying to say is that in case I am purchasing the slots in the other ship, in that particular case, I can still be claiming the tonnage tax scheme. It's not that I'm purchasing the entire ship, but only the portion of that ship I'm taking for the purpose of the carriage of my passengers or the goods. Clear? Yes or no? Yes? Okay. Next is Anil Hardware Store, HP High Court. In case where a partnership deed does not specify the remuneration payable to each individual working partner, but lays down the manner of fixing the remuneration. So the partnership deed is not giving the exact remuneration payable to each partner, but it just says how the remuneration will be computed. Will you allow a deduction under 40B? So the HP High Court said that the manner of fixing the remuneration has been specified. Sorry. And the partners may decide to invest how they want to take the profits or the remuneration. So the manner of remuneration has been let down. And therefore, the firm is entitled to deduct even if the individual partner's remuneration is not mentioned. The firm is entitled to deduct the remuneration under 45. Clear? So every partner may decide if he wants lesser remuneration, that's fine. The working of the remuneration has been specified, that is also in. Clear? These are the judgments which we have already done in respect of the cooperative society. Next is Govindbhai Mamaya case, Supreme Court judgment. Where the land inherited by three brothers is compulsorily acquired by the state government, will the capital gain be assessed in the status of AOP or in the individual status? So these three brothers had inherited a property on the death of their father, and this was compulsorily acquired by the state government, and the state government paid the compensation for this. Now, whether they would be assessed as AOP, that was the question. So here, the Supreme Court noted that these assessees were possessing the land by inheritance. It is not a AOP formed by violation or, by a mutual decision to go ahead and do some business. There was no business interest of the three assessees. The government compulsorily acquired the land. These were inherited by these three people. So this is not AOP. This is going to be taxed in their individual hands. Fine? Any questions, any doubt? Yes? Shall we take a break over here? Yes? If there are no questions, we'll take a break over here. we are going to start with is the assessment of the trust. Okay, so this is the next topic that we are starting with, taxation of the trust or the assessment of the trust, as you may want to call it. Now, we are going to deal with different kinds of trust in this particular topic. First, securitization trust. Second, real estate investment trust or the InVITs. Next, alternate investment funds, AIF. Next is the charitable trust. And lastly, the private trust. Okay, so first we are going to talk about these three trusts, which is the securitization, REIT, InVIT, and the AI. We will try to cover till this point today. In the next class, the next two classes that we will have, we will be focusing on the charitable trust and then finally the private trust. Okay. So let us first talk about the securitization trust. What is the securitization trust? Any idea? Yes. Any idea what is the securitization trust? No? Okay. So usually in the case of the banks or the financial institutions, what does the banks and financial institution do? They give the loans, right, to the borrowers against the pledge of assets. Yes or no? On security of the assets, right? Now, bank, in order to generate the funds out of these assets, right? What will the bank do to keep these assets with themselves? The bank would obviously want to monetize them. So the banks would pledge these assets to the securitization trust. And what securitization trust does it? This will give the funding to the banks against this assets. Right? So who constitutes this securitization trust? So there are investors which give the funding to the securitization trust against the security notes or security receipts. So the role of the securitization trust, students, is the role of the securitization trust is basically it is a financing trust, right? It is a special purpose vehicle that takes the financial assets, that takes the assets from the bank. It could be loans, it could be other assets, and this gives the funding then to the banks. This process is called the securitization because the bank, if it will hold the assets of the borrowers, it will not be able to generate any income. So the bank, in order to generate that income, will pledge it further with the securitization trust. Are we clear? Is the meaning of securitization trust understood?
Yes, ma'am. When bank pledges these assets and takes funds, then bank will also be paying interest to those investors, right, ma'am?
No. Bank is taking the assets as a pledge from the, the securitization trust is taking from the bank. Bank is taking it from the borrowers. So the bank is taking the funding against these assets. Of course, the bank would be paying interest to the securitization trust for that particular funding also.
Okay, ma'am. Yes, ma'am.
Yes.
Yes.
Now, how the income taxability works in respect of this. Now, the securitization trust income which is there, right? The income of the securitization trust is exempt. The income of the securitization trust is exempt. So, the securitization trust which is there, it is a exempt entity. Its income is entirely exempt. So, under 1023 DA. Are we clear? So, income of securitization trust is exempt under 1023 DA. Now, what about the income of the investors? Alright. So, in that particular respect, the securitization trust is considered as a pass-through entity. What do we understand by a pass-through entity? It means that income is not taxable in the hands of the securitization trust, but it will be taxable in the hands of the investor. The income passes it on to the investor and gets taxed in the hands of investor. Are we getting it? So, income of the securitization trust is taxable in the hands of investor. Okay? And the income of the securitization trust will get taxed in the hands of investor in the same manner in which if the securitization trust would have earned. So it will be taxable in the same manner as if investor had directly invested in underlying asset. What does it mean? So nature and characterization of the income in the hands of investor shall be of the same nature shall be of the same nature and in the same proportion as if it was received directly by the securitization trust. Now you would ask, what is the meaning of this? So let's say the total income of the securitization trust is 10 lakh. Fine. Let's say this is bifurcated within different heads. Let's say PGBP 2 lakh, IFHP 6 lakh, and let's say EFOS 2 lakh. So this is the ratio of 1:3:1. Let's say now the investor, there are 10 investors in this particular trust. Okay. So income of each investor, the income of each investor will be, let's say, 1 lakh. Correct? Now this 1 lakh will be characterized, the nature and the characterization of it would be same as it is in the hands of the securitization trust and in the same proportion also. So out of 1 lakh, 1:3:1 will go under the head of PGBP, IFHP and IFS. Are we clear about this, students? Yes or no?
Yes, ma'am.
Okay. And plus there will be TDS when the securitization trust distributes the income to the investor. So there will be TDS on the income payable to investor under 194 LBA. If it is paid to resident, then it will be 10%. Right? If the TDS is paid to a resident, sorry, LBC, not LBA, LBC. One second, I think there's some hang. If the investor is a resident, in that particular case, it will be 10%. Okay. And if the investor is the non-resident, then this will be at the rates in force. Okay. Any question, any doubt? Is this clear?
Clear, ma'am.
What is the meaning of rates in force?
As per the treaty between the two countries,
It means the rate under the Act, either under the Finance Act or Income Tax Act or the DTAA, whichever is beneficial. Fine. Yes, is this clear? Any
yes,
question about the securitization trust?
clear, ma'am.
Okay. So very simple for the securitization trust. Okay. Now next we move on to the, after the securitization trust, we move on to the, yes, AIFs, alternate investment fund. Now what are AIFs? Any idea? Yes. Yes, any idea about AIF? Okay, let me explain. So these are asset management companies, or investment companies, or investment vehicles as we may call it. So what they do is they make the investment in ventures, in startup, in different asset classes. Private equity funds, hedge funds, real estate, commodity fund, derivative funds. These are different kinds of funds. Right? They may invest in equity share of unlisted company. They may invest in shares of listed company. So there are different categories of the AIF. Category 1 of the AIF, which is there, they invest in the startups or infrastructure based projects. Then we have category 2 funds, which invest in, let's say, companies which are not startup but in the mid sector of growth. They invest in pre-equity round, pre-IPO round, like that. And then category 3 AIF are the investment funds which invest in the shares of the listed company. So there are 3 categories of the AIF. Now, the income of the AIF which is there again. How the taxability works. Let us understand. So with respect to the taxability of the AIF, it is not same as the securitization trust. It depends on, the taxability of the AIF depends on whether the income is in the nature of PGBP or any other income. If the income is in the nature of PGBP, then in that particular case, the taxability is in the hands of the AIF. So if the income is PGBP, if income is earned under the head of PGBP, then in that case there is taxability in the hands of the AIF. Are we clear? Yes or no? And in the hands of the unit holders, in the hands of the investors, this shall be exempt under section 1023 FBB. So if the income is in the nature of BGBP, it will be taxable in the hands of the AIF. And in the hands of the investor or unit holder, this income shall be exempt under 1023 FB. What is the tax rate which is applicable for the AIF?
Depends if it is a company or LLP
Yes,
partnership.
correct. So if the AIF is incorporated as a company, AIF can be company, it can be trust, it can be partnership also. So if it is in the nature of company, what will be the tax rate?
30% or 25% or 22%.
30, 25 or 22. Yes? Sorry. If it is LLP or partnership firm,
30%.
correct? And if it is AOP, BOI or the trust, then
AOP, BOI, MMR,
AOP, BOI or trust, what is the tax rate?
Individual states, right?
No,
India.
no. That is only in respect of C. That's what we learned, right? That was
If it is
only
greater than basic exemption limit and
correct. No member has income greater than basic exemption limit. If any member has income greater than basic exemption limit or the shares of the members are unknown, it will be taxed at
MMR.
maximum marginal rate. Okay. So this will be going to the maximum margin rate. Clear? Now, if it is other income, it is not business income, any income other than business income, then in the case of the AIF, it will not be taxable.
Ma'am, for trust also this MMR rates ne AOP
Yes.
rates.
Yes. So any other income not taxable in the hands of AIF. So in that case, in the case of any other income, it will be treated like a securitization trust only, like a pass-through entity. It will be taxable in the hands of investor. So if it is not taxable in the hands of AIF, it will be taxable in the hands of investors in the like manner and in the same nature in the same nature and proportion as if directly received by the AIF. Okay. So if it is other income, then this will be exempt in the hands of the AIF under 1023 FBA. And in the hands of investor, this will be taxable under 115U. Clear? So in that particular case, it will be taxed just like the securitization trust only. Is this clear?
Yes, ma'am.
Okay. Now, there is a different treatment here in respect of the losses. So now, if it is PGBP loss under the head PGB, income is taxed in the hands of AIF. So the losses will also be allowed to be carried forward and set off by the AIF. This is not there in the case of securitization trust, okay? The investors are not allowed the losses. Whereas in case of other losses, other than PGBP loss, in that case, there is condition. What are the conditions which has been mentioned? So, in respect of the losses under any head of income, since the income is not taxed at the fund level, the losses cannot be set off against any other head of income for that fund also. Only the PGBP loss will be allowed. However, in the hands of the investor, for the losses to be allowed, they have a condition. What is the condition? That the units should have been whole for a period of at least 12 months. So here you can write losses not allowed to be set off at fund level. Losses allowed to the investors. But what is the condition? Units should have been held for at least greater than equal to 12. Meaning if the units are held for less than 12 months, losses cannot be carried forward and set off even by the investors. Clear? Yes or no?
Yes, ma'am.
Okay. And when the AIF pays the amount to the investors, the AIF distributes the amount to the investors, there will be TDS just like we had it under the securitization trust. What will be the TDS here? TDS under section 194 LBB. TDS under section 194 LBB. For the resident, again it is 10%. And non-resident at the rates in force. Clear?
मैम
Yes.
अभी इनकम है जिसको है ना नहीं सेम नेचर सेम प्रोपोर्शन में डिवाइड करते हैं इन द
Yes.
सेम मैटर लॉसेस विल आल्सो बी डिवाइडेड इन सेम नेचर एंड सेम प्रोपोर्शन
Yes.
और इन्वेस्टर अपना इंडिविजुअल रिटर्न में भी सपोज लॉस अभी इनकम फ्रॉम हाउस प्रॉपर्टी में आया ओल्ड रेजिम में तो ही कैन सेट ऑफ फ्रॉम डिफरेंट हेड्स इन हिज इंडिविजुअल
Yes. Yes.
ओके
So it will be in the same proportion and in the same nature only as it is in the hands of the trust. So it will be treated like if the individual would have directly invested, what would have been the treatment? Same way it will apply. Because this is a pass-through entity.
ओके
Clear? Okay, let us solve a question from the module on this. The following are the particulars of income of the 4 investment fund A, B, C, D for previous year 25-26. Compute the total income of the investment fund and each unit holder for AY 26-27, assuming that each investment fund has 20 unit holders, each having 1 unit held by them for a period exceeding 24 months. And income from investment fund is the only income of the unit holder. So first we'll see up till this part. So let us talk about the fund A. What will be the taxability in the hands of the fund A? Yes.
Sixteen divided by 20 for capital gains, and 4 divided by 20 will be income from other source. It is not a business income.
Yes, but will there be any taxability in the hands of the fund?
No, ma'am.
There will not be any taxability in the hands of fund, right? Because
Yes,
there
ma'am.
is no business income.
No business.
What about the unit holder? So it will be
It will,
taxable in the hands of the unit holder.
yes, ma'am.
So there are 20 unit holder, each having 1 unit. So 20 is the total income divided by 20. So each unit holder's income will be 1 lakh. Right? We are going to talk about 1 unit holder only. Right? So 1 lakh into 4:1 ratio is there. Right? So 80,000 will be taxable under the head capital gain for the unit holder, and 40,000 will be taxable under the head income from other sources. Clear? Yes or no?
Yes, ma'am.
Okay. Then for the fund B, 2 lakh is the business income, 14 lakh is capital gain, and EFOS is 4 lakh.
For PGBP income, it will be taxable in the hands of the trust, and it will not be taxable in the hands of the investor. And capital gains and income from other source, it will be passed through, and it will be taxable in the hands of the investor.
Correct. So 2 lakh will be taxable in the hands of the investment fund. Now we don't know what is the status of fund. If it is company, it will be taxed at 30, 25, 22%. If it's a LLP, then it will be taxed at the rate of 30%, or if it is trust, then MMR or AOP MMR. This 14 and 4, which makes it to 18 lakhs. Now 18 divided by 20, each investor will get how much? 9 lakhs.
3,000.
Correct? Or 90,000. Sorry.
Nine.
Yeah. So 90,000, and that will be divided between the ratio of 7:2. So 70,000 as capital gain, 20,000 as the income from other sources. Fair? Understood till now?
Yes, ma'am.
Then 2 lakh is the business loss, 6 lakh is the capital loss, and 8 lakh is the income from other sources.
Two lakhs business loss will be allowed to the trust, and remaining 6 and 8 in that it will be transferred to the investor.
See
Ma'am,
here.
यहाँ
Yes.
पे नेट ट्रांसफर होगा 2 lakhs या फिर सेपरेटली
question.
6 and 8 ट्रांसफर होगा?
So here first 2 lakh will be adjusted against 8 lakh. So always, this is the current year loss. So you will adjust against the other head of income. Right? So this 2 lakh will be set off against 8 lakh. So the remaining 6 lakh will be taxable in the hands of the investor. Clear? So it is not that you will not set it off against the other sources. You will set it off. So this 6 lakh divided by 20 unit holders coming to 30,000. This will be taxable in the hands of the unit holder. You will set it off against the other head of income. Clear? Then this 6 lakh which is there, which is a capital loss, this will be allowed to be carried forward by the investor. But what is the condition?
Units have to be held for greater than or equal to 12 months.
For more than 12 months. Right? Now this can be set off by the unit holder since the units are held by for more than 12 months. Clear?
So first, within the trust, we have to
Correct.
make the set of losses, and then we will be passing.
Correct.
Okay.
Next is business income of 5, capital gain of 20 and income from other sources 2.
So 3 lakhs will be PGBP income for trust, and 20
Correct.
lakhs will be passed through. 1 lakh for each investor. 25.
Correct. So this 2 income from other sources will be first set off against the other head. Whatever is carry forward, that will be allowed to investor, not to the trust. Carry forward cannot be done by the fund. So this 2 minus 5, 3 lakh which remains, that will be taxable in the hands of the fund. Remaining 20 which is there, 20 divided by 20, 1 lakh will be taxed in the hands of the investor as the capital gain. Clear?
Yes, ma'am.
Yes? Okay. The second part of the question is asking if the investment fund C has the following income components for AY 27-28 next year. What would be the total income of the fund and the unit holder for that year? Business income 2 lakh, capital gain 9 lakh and income from other sources 8 lakh.
Next year, business income will be taxable for 2 lakhs because already in the previous year it was set off against from income from other sources. So there are no
Yeah.
losses. So business income will be taxable for the trust for 2 lakhs, and capital gain it will be divided by 20, and there is a loss carry forward for the investor, so it will be set off, and 8 lakhs it will be taxable in the hands of the investors divided by 20.
Correct. So 6 lakh was the long-term, capital loss. We don't know whether it's long-term, short-term. So we are assuming here that, it is, let's say, short-term only because short-term can be set off against long-term capital gain as well as short-term capital gain, right? So you will have to assume that this is either long-term or even if it is short-term, you can set it off against this capital gain, which is 9 lakh and we are assuming that the gain is long-term only. So this 6 can be set off against 9. So 6 divided by 20 comes to 30,000. This can be set off against 9 lakh divided by 20, 45,000. So net 15,000 will be taxable in the hands of unit holder. And other sources, again 8 lakh divided by 20, 40,000 will be taxed in the hands of unit. Is AIF clear to everyone? Yes?
Yes, ma'am. Yes, ma'am.
Okay. Let us move to the next part. Real estate investment trust or the InVIT. Any idea what are these?
Immovable properties
Correct.
कोई trust करना.
Correct. So, real estate investment trust or the infrastructure investment trust, REIT or InVITs. These are SEBI regulated trust, right? They invest in the underlying asset as the real estate, right? Now, this is a very complex framework which governs them. Okay. So, let us understand it one by one. So, first of all, be very attentive to this. Okay. It's not very easy as once you understand it will be easy, but be attentive. There can be a special purpose vehicle. SPV. Right? What is SPV? It's a company, normal company. We are calling it as a special purpose vehicle because its purpose is specific that it may want to acquire the real estate. It is just an investment company. It could invest in shares, it could invest in real estate, whatever. It's like a specific purpose entity. Set up with the only object of investing in the underlying objective what it has. Either shares of other company, either real estate, whatever. So here my SPV wants to invest in real estate. Now this is a company only. So who will be its member? Shareholders. Right? Or I will call it as sponsor. Right? So okay. So it has, let's say, shareholders. Or I will call it as sponsor. The one who are sponsoring the company or the shareholders. Right? Now, this SPV, this is a company. Correct? Now, what I will do is, now this company wants to invest in the immovable property. Correct? Now, what we will do is, these shareholders or sponsor will give the shares of this SPV to a REIT. Right? So what will happen? This SPV will become subsidiary of REIT. Yes or no? Clear? Yes? Yes or no, students? Are they yes or no?
मैम एक और बार explain करेंगे.
Yes. This SPV which is there, this is a company, right? It has a specific objective of investing in the real estate, correct? Or immovable property. So basically, this is going to invest in the immovable property. Now, in order to operate into this business, it wants to start a REIT, right? So what will the shareholders of this SPV will do? They will sell the shares of SPV to a REIT. So REIT will have a subsidiary as SPV. When the shareholders of this SPV will transfer the shares to REIT, REIT will become the holding company for this SPV. Yes or no?
Yes, ma'am.
Right? REIT is going to become the shareholder of this SPV now. Yes?
Yes, ma'am.
Yes.
Right? ये जो shareholders ने shares transfer किए अपने REIT को, तो अब REIT हो गया ना shareholder. Yes? Now, in return, the REIT will give to the shareholders some consideration. Correct? Free में तो shares लेंगे नहीं. It will give some consideration. Yes or no? Now,
Yes,
what
ma'am.
consideration it is giving is units of the REIT. So, final structure क्या हो जाएगा? मेरे shareholders यहाँ आ जाएंगे. They will become unit holders of REIT. REIT will become the shareholder of the SPV. And SPV has underlying investment in the immovable property. तो जो मेरा पहला structure था, like this is becoming like this. Yes or no?
Yes, ma'am.
Clear, everyone? Yes?
Yes, ma'am.
So the shareholders are transferring the shares of SPV to REIT, and REIT will give in return the units. REIT will issue the units to the share. Clear?
Means all the shareholders will give their shares to
Yes.
REIT.
For now, we are assuming like that to understand the tax implication. Okay?
Yeah.
Okay.
Yes.
Now, whether this will be attracting the capital gain. Transfer of shares of SPV, getting the units of REIT in return. Whether this will attract the capital gain. Yes.
Not a
In the
transfer
hands
under
of shareholder.
not transfer under section 47.
Very good. This is not regarded as transfer under section 47. So there will not be any capital gain in the hands of the shareholder, because there is a specific exemption in respect of this. Are we getting it? So when the shareholders will transfer the shares of the SPV to the real estate investment trust, in that particular case, it will not be regarded as a transfer. There is a specific exemption for this under section 47 of the Income Tax Act. So there will not be any capital gain in the hands of the shareholder. Clear? Up till this point, clear?
Yes, ma'am.
Fine. Now, let's say, for example, if this shareholder was a company. If shareholders were not individual but company. Correct? This is the P&L of company. Correct? Here there will be notional gain or loss on sale of shares. Yes or no? As per the AS, there will be notional gain or loss on exchange of shares for units of business trust. Yes?
Yes, ma'am.
I'm not writing sale, I'm writing exchange of shares. So to make it clear. Now this is a company. So MAT is applicable. Correct?
Yes, ma'am.
Yes, ma'am.
Now if you go to the MAT chapter, we had done one adjustment here. Notional gain or loss on transfer of share of SPV in exchange of units of business trust, or notional loss due to change in the carrying value of units has to be added and gain is to be reduced, because this is notional. Yes?
Yes, ma'am.
Yes, ma'am.
So here under MAT, what will I do is this I will reduce gain or add loss from book profit for MAT calculation. Clear? Is this clear
Yes,
till
ma'am.
now? Yes? And
Yes,
what
ma'am.
did I tell you here? the actual gain or loss on sale of units of business trust has to be added. So that means what? When these shareholders will sell the units of the REIT at that point in time, you will add or less under the profit. Clear? Yes or no?
Clear, ma'am.
Yes, ma'am.
So, here you will write when units of REIT are actually sold, actual gain or loss shall be added or reduced from book holdings. Clear? Okay. Now, when units of REIT are sold by unit holder, there will also be capital gain. Yes. There will also be capital gain.
Yes.
Okay. Now, what will be the period of holding for these units? 12 months, 24 months. What is the period of holding?
Units of business tax, 12 months.
12. So, before 2024, this used to be 36 months. So, now it is 12 months. So, my period of holding under 242A will be 12 months. And from when will you count the period of holding for these units? So, this shall include the period of holding of shares of SPV. So, the period of holding of shares of SPV will be clubbed for the purpose of determining the period of holding of units. Yes or no? Yes?
Yes.
Yes, ma'am.
Okay. Now, if it is STCG, less than 12 months. And if it is LTCG, STCG will be taxed at what rate?
20%.
20% under 111A. Plus surcharge and cess, whatever applies. Clear? This will be covered under the 111A because the units of the REIT are mandatorily listed. Okay? These are not unlisted. So these are listed on the stock exchange. And if you look at 111A, it covers specifically the units of the business trust. Clear? What will be the tax rate for the long term?
12.5%.
12.5% over and above 1.25 lakhs. So this is covered under 112A. Are we getting this? So under section 112A, 12.5% plus surcharge and cess over rupees 1.25 lakhs. Yes or no?
Yes, ma'am.
Yes.
Yes. Now, what would be the cost of acquisition of the units?
Cost of acquisition of SPV.
Of the units of the business trust.
Special purpose vehicle.
No, of the
What is
business
it?
trust, of the REIT. These are the shares, not units. So what will be the cost of these units? We are talking about the units.
Shares of the SPV will be the cost.
Correct. So the cost of acquisition of unit will be the cost of acquisition of the shares of the SPV. Clear? Yes or no?
Yes, yes.
So this is under section 49 2AC. This is the first part. Now we are coming to the taxability of the REIT. Okay? First part clear to everybody? Okay?
Yes.
Now REIT, how is it taxed? Again, it depends on the type of income. Okay? So let's say, for example, the REIT can have, first of all, direct rental income, or it can have the indirect incomes. So REIT is holding the SPV. Which holds the immovable property. Fine. This is one way of doing the business of immovable property. Or it can directly invest in the immovable property. Yes or no? Right? Yes?
Yes, ma'am.
Fine. Now, in respect of first, we will talk about the direct holding in the immovable property. So, when it is directly holding the immovable property, it can earn the rental income. Correct? It will earn the rental income. Now, what will be the taxability of this rental income? This rental income will be exempt in the hands of REIT. This is exempt in the hands of REIT. Under section 1023 FCA. Fine. Now again, REIT is treated like a pass-through entity. Meaning any income which is not taxable at the level of REIT, if it is distributed to the unit holder, it will be taxable in the hands of the unit holder in the same manner and same proportion as if the unit holder has directly received it. Right? So this income will be taxable in the hands of the unit holder. Clear? Now, when this rental income will be paid by, let's say, tenant to REIT, will the tenant deduct the TDS under 194I? There is a TDS under 194I, right? On the rental payments? Yes or no?
Yes, ma'am. Yes, ma'am.
Yes. So your TDS will not apply because this is exempt under 1023 FC. So no TDS under section 194I. Fine. However, when the REIT distributes the income to the unit holder, it has to deduct the TDS under 194 LBA. So if it is a resident, 10%, and if it is a non-resident, rates in force. Is this fine? First part? Yes?
Yes, ma'am.
Clear? Now, one more important aspect. In the hands of the unit holder, how will this income be characterized? Yes?
Same manner, same proportion as that
Same
of REIT.
manner and same proportion. So, what is the nature of the rental income? Under which head do you tax it or characterize it?
मैम रेसिडेंशियल हाउस प्रॉपर्टी पीजीबीपी में पढ़े थे कि it will be taxed under income from house property only, even
Correct.
if it is for business also.
Correct. So, see, it is the business of the REIT to earn the rental income, right? It is a business of the REIT to earn the rental income. However, there is a specific carved out from section 28, which says that rental income, even if it is your business, so from the residential house property, explanation to section 28 says now, explanation 3 to section 28, that this will be chargeable under the head IFHB. However, in respect of the commercial property, right? In respect of the commercial property, what will happen?
PGBP.
PG. On what basis? What is the basis of saying this?
REIT since REIT it is a business of renting the property and earning rental income from there. Section 28 business.
No. Chennai Property Supreme Court. Since the REIT is in the business of renting out the property and generating rental income, as per the Chennai Property Supreme Court ruling, the income would be taxable under the head PGB. And for the unit holder also, the same characterization will be. Yes or no? Yes?
Yes, ma'am.
Fine?
Yes, ma'am.
Okay, now next can be through the SPV. Now, SPV will earn the income from the immobile property. But for REIT, that will not be the income from immobile property. The SPV will distribute either the dividend, right? Or will give interest on the loan if REIT has given the loan to the SPV. Yes, these can be the only two ways. Yes or no?
Yes, ma'am.
Yes. So first we'll talk about dividend. In the hands of REIT, the dividend received from the SPV by the business trust in the hands of the REIT again remains exempt under 1023 FC. Further, there will not be any TDS under 194 by the SPV while distributing the dividend to the business trust because this is exempt dividend. So SPV is not required to deduct any TDS under 194. 194. Clear? now in the hands of unit holder. Obviously, if it is exempt in the hands of the business trust, this should get taxable in the hands of the unit holder. Yes or no?
Yes,
Yeah.
ma'am.
But here you need to ask a question to the business owner. What is the question? The question is whether the SPV has exercised tax under section 115BAA. What is the tax rate under 115BAA?
22%.
22%. If the answer is yes, then dividend taxable in the hands of unit holder. Then dividend taxable in the hands of the unit holder. Are we clear?
Yes, ma'am.
So only when the SPV has exercised the option under 115BAA of concessional tax regime, it will be taxed in the hands of the unit holder. What will be the tax rate? In case of resident unit holder, normal rates of tax. However, the business trust is required to deduct the TDS on the dividend distributed to the unit holders at the rate of 10%. So there will be TDS under section 194 LBA. How much is it? 10%. If the unit holder is non-resident, if the unit holder is a non-resident, then in that particular case, the tax rate will be 10%. However, it is not a defined tax rate. See, if you go in your module also, they have given a note. And you have to write this note in the examination as well. So 10% is the rate in case of unit holders is given. However, they have derived this. It is not specified in the act. How they have derived it is because the TDS in respect of this dividend paid to the non-resident unit holder is 10%. So they have said that the tax rate cannot be more than the TDS. Alright. So what they have said is that that's the reason why we are taking it as 10%. But there is no specified rate in respect of this distribution to the unit holder or taxability in the hands of the non-resident unit holder. The general rate of dividend in the hands of non-resident is 20%. So they have given a note on independent reading of 115A. It is possible to take a view that the tax rate for such dividend income is 20%. Okay. So it is not given, it is derived that the tax rate cannot be less than the TDS rate. Or TDS rate cannot be more than the tax rate. So, I'm just writing 20% as per 115A. In my view, it should be 20%. TDS under section 194 LBA is 10%. Clear? Yes? And where the SPV has not exercised the option under 115BA, then dividend not taxable even in the hands of unit holder. Is this clear, students? Yes or no?
Yes, ma'am.
Yes.
Next is interest. If the SPV pays the interest to the REIT. Alright. So in that particular case, I'm writing here below. SPV pays interest to the REIT. Okay. Now this is not taxable in the hands of the REIT under 1023 FC. So that means this will be taxable again in the hands of the unit holder. Right? So just like all the other income, this should also be taxable in the hands of the unit holder. So in that particular case, what is the tax rate? Or we can just first write here. Taxable in the hands of the unit holder. If it is resident unit holder, then in that particular case, the TDS will be, the tax will be at the normal rate of tax. And TDS will be there under section 194 LBA at the rate of 10%. Fine. And if it is non-resident unit holder, then this will be taxable at the rate of 5% under section 115A. And again, my TDS under section 194 LBA is 5%. And when SPV pays the interest to the REIT, no TDS under section 194A is required to be deducted by SPV to the REIT. Clear? Yes or no?
Clear.
Okay. Now, it is possible that the REIT is also paying some interest. REIT could have also borrowed some funds. Let's say REIT has also borrowed some funds and it is paying the interest. Right? So, if it has borrowed from the unit in the IFSC or through the rupee denominated bond listed in IFSC. Right? So, in that particular case, it would be taxed at the rate of 9. The TDS is required to be deducted at 9%. Through the bonds or rupee denominated bonds. Bonds denominated in rupee listed on IFSC, then the REIT is required to deduct the TDS at the rate of 9%. Yes? Is this clear? Yes or no?
Yes, ma'am. Ma'am,
So
under
if it
which
has
section?
yes.
Section?
Sorry?
TDS का section में.
194 LC.
Okay.
LC. Clear? Otherwise, it is 5%. On other interest, if it is paid to a non-resident, it's 5%. Fine?
Ma'am,
Okay.
जो इंटरेस्ट REIT पे कर रही है, so will it be also be passed through the unit holders?
No, this is the payment of interest.
Yeah, payment of interest by the REIT, right, ma'am? So it is a
Yes.
kind of expense to the REIT.
That is an expense to REIT. See, that is going to be, it's going to be a business expense. So any which ways you will be taxing the business profits of the REIT. After all the expenses, you will not tax the gross receipts. You will tax the business profits.
Okay, ma'am.
Right?
Yeah.
So these are the two category of income. Interest हो गया, dividend from SPV हो गया, and then directly rental income हो गया. Now, what about it can sell the immovable property? Yes, if it is selling the immovable property or any shares that it is holding, so क्या होगा? Capital gain. Yes or no? It can have capital gain. So in case of capital gain, so income from the capital gain on sale of assets. Income from capital gain on disposal of any asset. So in that particular case, in case of the sale of equity shares, right? In case of sale of equity shares which are long term, or in case of any other asset, 112 will apply, or 112A will apply for equity shares. Clear? So you can write here LTCG for the equity shares, or for assets you can write like this, covered under 112A, 112A will apply. LTCG others, 112 will apply. STCG on assets covered under 111A, 111A will apply. And STCG on other assets, maximum marginal rate will apply. Clear? Yes?
Yes, ma'am.
And this will be not taxable in the hands of unit holder because REIT is paying the tax here. So this is exempt under 1023 FD. And any other income apart from this arising to the REIT, right? Other than interest, dividend, rental, capital gain, this will be taxable in the hands of the REIT at MMR. So, any other income taxable at MMR and exempt in the hands of unit holder. Are we clear? Yes or no? Yes?
Yes, ma'am. मैम एक
Yes.
नॉर्मल क्वारी है. अभी SPV कंपनी है ना मैम, so company is holding a house immovable properties. So for that company also it will be applicable कि residential house properties है
Yes,
तो
yes, for everyone.
for everyone.
This is a principle which is coming from PGBP, so this is applicable for everyone.
Okay.
Not just
Okay.
to the. Okay. So with this, we will stop here. I would request you to revise this REIT properly. There are some more principles for the REIT that we are going to cover in the next class. And we will also solve a question in the next class. Okay? So that's all for today. Thank you so much.
Thank you, madam.
Thank you,
Thank
ma'am.
you.
Happy Diwali.
Yes, happy Diwali to all of you. Please study well. Utilize your Diwali vacation to revise everything, because it shouldn't happen that you lose the touch. You've got this time. Please utilize it fully. Of course, enjoy your day. It's the very big festival for all of us. But at the same time, we are in this very, very important journey of CA, wherein all these festivals, of course, can be celebrated with much more enthusiasm next year. So my request would be that, also, like, beyond the day, do not spend that much time. Just invest to study as much as possible, because you would not get this time back. So a happy Diwali to all of you, to your family as well. Thank you so much. We'll meet after Diwali.
Yes, ma'am. Happy Diwali.
Happy Diwali. Yes. Thank you.